Hi students, welcome to the video on financial statements at your fingertips. Already we have discussed in video number 1 all the adjustments, simple adjustments like closing stock, outstanding expenses, prepaid expenses, accrued income, income received in advance, depreciation on fixed assets, then bad debt written off, provision for bad and doubtful debt, provision for discount on debtors, reserve for discount on creditors, interest on capital, interest on drawing. In this video, we will discuss some typical adjustments, that is hidden adjustments related to final account with GST. So, all of you know, when the business purchase the goods, business from the supplier, business has to pay GST to the supplier. If the supplier and the beneficiary, that is the businessman or trader, belongs to same state, they have to pay SGST and CGST at the rate 50-50. That means suppose 12% GST, then 6% GST will go to central government, that is CGST. Another 50% will be with state government, that is SGST. But when goods are purchased from interstate, that means the dealer belongs to one state and the beneficiary or the recipient belongs to another state, then entire proceeds of GST will be treated as IGST, will be remitted to the central government. So at the time of purchase of goods, the GST paid is known as input GST. At the time of sale of goods, the GST paid is known as GST collected from our customer or the customer of the business is known as output GST. Then the whatever the input GST, it may be inputs SGST, CGST, IGST will be adjusted from the amount collected from our customer in terms of output SGST, CGST and IGST, and there is proper procedure for a write-off that we already discussed. Then that is known as input GST, that is input tax GST. So in this video, we will focus on some adjustments. First is, the manager is entitled to commission of 10% of net profit. One is before charging commission and second is after charging commission. So before charging commission, this is like this. Let the net profit be 100. Suppose net profit before charging commission $100. Then suppose commission is 10%. So net profit after commission is 90. 10% 10. So net profit after charging commission is 90. After charging commission is 90. Suppose in the question it is given net profit after charging commission. Net profit after charging commission 10%. That means after charging commission 10%. So commission payable will be calculated like this. commission, that is percentage commission, suppose 10, then 100 plus percentage commission into net profit after charging commission. Net profit after charging commission. Suppose profit is 1,10,000. Suppose profit is 1,10,000 after charging commission. Then commission is 10 by 110. 10 by 110 means 1 by 11. That is 10,000. So commission is 10,000. So net profit after charging commission, suppose it is net profit after charging commission, suppose it is 1 lakh, then commission is 10%, that is 10,000. So net profit before charging commission is 111,000. So net profit before charging commission, it is directly calculated as a percentage, that is 10% on that net profit before charging commission. When it is in the question, it is given net profit after charging commission 10%, then we have to calculate 10 by 100 plus 10 into net profit after charging commission. Then the figure of sundry creditor include an amount of 2,000 received from Rahul and credited to his account. The amount was written off as bad debt in the previous year. So, sundry creditor includes an amount of 2,000 received from Rahul. So, from sundry creditor, we deduct 2,000 on the liability side. Then sundry creditor on the liability side, it is suppose sundry creditor that was sundry creditor include amount of 2,000 is credited to the amount was written off as bad debt in the previous year. So we will deduct this amount from sundry creditor. Suppose sundry creditor was 62,000. So we will deduct 2,000 from it. So sundry creditor is 60,000 and 2,000 will show in profit loss credit side by bad debt recovered. Amount written as bad debt in the previous year by bad debt recovered. That is 2,000. So our net profit will be increased by 2,000. As a result, capital will be increased by 2,000. Sundry creditor will be decreased by 2,000. So it will tally. Then provision for bad debt and provision for discount on data. Already previous video we discussed, now we are also discussing. So this is profit and loss account. This is in the balance sheet, sundry debtors. Balance sheet, asset side, sundry debtors. So in sundry debtor, suppose sundry debtor is 1 lakh, then less bad debt written off. Suppose bad debt written off is written off. It is suppose 10,000. So it is 90,000. Less provision for bad and output debt. Suppose provision for bad debt, bad and output debt is, suppose it is given 20%, so it is 18,000 of 90,000, 20%, 18,000. So it is 72,000. Suppose less provision for discount on debtors. Provision for discount on debtors. Suppose it is 2%. We will calculate 1440. Then in the profit loss we will adjust everything. To bad debt return off, add provision for bad debt, plus add provision for discount on debtors. So another is reserve for discount on creditor. So here this is sundry creditor. Suppose it is 50,000. Reserve for discount on creditor, suppose 2%. So reserve for discount on creditors. Reserve for discount on creditors, suppose 2%. 2% means 1,000. So it is 49,000. Then reserve for discount on creditor will be shown in the profit loss credit side by reserve for discount on creditors. Then it is given following is figure in the trial balance. So trial balance figure is given. Income tax 4,500, income tax advance payment 500, and interest on advance payment of tax 200. All of you know, whatever income tax paid by the business, it belongs to proprietor. So whatever expenses, goods used by the proprietor for his personal use, it will be debited to drawing account. Here is paying income tax and income tax advance payment, both 5,000. It is treated as drawing. So this is first is profit loss account, then second is balance sheet. In the balance sheet, from capital, we will less drawing. The amount is 5,000. Then interest on advance payment of tax 200. Then 200 will add interest on advance payment. Interest on advance payment. That is 200 we will add, or 200. A manufacturer of medicine, used medicine for personal use worth 300. So he is using the medicine for personal use of 300 and distributed all free sample worth 2,500, gave to the office staff worth 1,000 for personal use. So first, when he is using the medicine for his personal use, we will debit drawing. So drawing account debited. Amount is 300. Then distributed free sample means advertisement account debited. Advertisement account debited. This is 2,500 and given to office staff. So salaries account debited. Salaries account debited. Sorry. How much? It is 1,000 to purchases. That is 3,800. If GST is included here, then accordingly GST will be debited to respective heads. Suppose GST is there, that is to input SGST, to input CGST, to input, suppose interstate, so input IGST. Then the portion of amount will be added here. So drawing will be deducted from capital. Then advertisement and salary will be debited to profit loss. Profit loss debit side right to advertisement 2,500 plus GST. Salaries 1,000 plus GST. Then drawing capital will deduct 300 plus GST. Then purchase will deduct 3,800 and we will show input GST, input CGST. If it is interstate will show input IGST. Included trial balance at the debtor of 61,000. So sundry debtor was 61,000. Sundry debtors in the balance sheet. So sundry debtors was 62,000. including the amount of 2000 in respect of a dishonored bill of Tirath Ram, who became insolvent. That means Tirath Ram has accepted bill of 2000 and became insolvent. So a dividend of 50% received from his official receiver. In case of bankrupt means when the person or the borrower is not in a position to repay his debt, he is treated as insolvent. Then insolvent person, the official receiver will be appointed. He will take all the assets and liability, and he will calculate how much is the realizable asset, how much is the liability. Accordingly, he will distribute the dividend. So here, Tirath Ram, from 2000, he received 50% from official receiver. So less 50% received. That is bad debt recovered. 50%. That is 1000. Another 61,000, then less bad debt, because out of 2000, 1000 treated bad debt. Bad debt is, that is from 62,000, he had deducted 1000, this is 61,000. So 61,000 minus 1,000, 60,000. Then less bad debt 1,000, it is 59,000. From bad debt, it is written 5% provision. Less provision for bad debt. Provision for bad debt. Amount is 5% of 59,000. So this is 0. Then 2950. This is all about shown in the asset side. Then bad debt 1000, provision for bad and doubtful will show here. Then bad debt recovered on the credit side. Then another adjustment. A manufacturer sells away part of the plant for 5,500 on 30 September 2023 at a profit of 25% on bank value as on 1st April. Book value, sorry. It is not, it is book value. Book value. That is original cost. Depreciation is written at 10% annum. Give plant account along with working note. So first we will start plant account. Under plant account, this is assets. So left side is debit side as opening balance, and this is credit side. What happened here? We will do working note. On the working note, we will see, let the book value of plant be, let the BV of plant be 100. When book value of plant is 100, then add profit. Profit is 25%. Profit 25%. That is sales price of plant is 125. When SP 125, then book value 100. When SP1, book value 100 by 125. When sales price is given 5,500, book value is equal to 100 by 125 into 5,500. So 4 by 5, that is 4,400. So 4,400 is the book value of plant. So write opening date 1st April 23. To balance brought down. So amount is 4,400. Then on 4,400, depreciation will calculate. Depreciation is 10% per annum for 6 months. So 4400 into 10 by 100 into 6 by 12. So it is 220. And 10, 440 into 220. This is 44,000. 44,000 means it is 2,200. 2,200. When depreciation 2,200, we are selling the plant for 5,500. So profit is, here we write by bank. Sales proceeds. Sales proceed is 5,500. This is not 44,000, 4,400. So it is 220. So 5,500 by depreciation. Depreciation is 220. Then to profit and loss account. Profit on sale of asset or plant. Profit on sale of plant. That we can calculate. The book value was 4,400. Out of that, 220 the depreciation. The reducing value is, that is 4180. Then sales price is 5500. So difference is 20. Then 1320. So profit is 1320. So total comes to 5720 on both sides. 5720. Then here what we will do? The balance sheet asset bank, we will write 5,500. We add 5,500. So depreciation will charge on the debit side of profit and loss account. Then there is profit. It will be shown in the credit side of profit loss account by profit on sale of asset. This is all about the adjustments. Then it is written in the trial balance, debtor appears 12,000. Suppose this is the trial balance. All of you know, trial balance serves as a summary of what is contained in the ledger. So trial balance as on suppose 31st March 24. Then this is particulars. Then debit balance, credit balance. Particulars, debit balance. This is credit balance. So written is debtors. So debtor is written 12,000. Then debit balance. Then creditor is written 7,400. But adjustment is given, provision for doubtful 5% on debtor, reserve for discounted debtor 2.5%. After considering the fact that included debtor and the amount of 2,000 due from X, included creditor the amount of 1,000 due to him. That means he is both a debtor to the extent of 2,000, creditor to the extent of 1,000. So we will deduct 1,000 from each side. That is, from sundry debtor we will deduct 1,000, from sundry debtor we will deduct 1,000. So it is 11,000, it is 6,400. So in the balance sheet, we will write sundry debtors. So sundry debtor is now 11,000 less provision for bad debt. Provision for bad debt. The amount is written 5%. 5% means 550. This provision will be deducted here in the profit loss. On the debit side we write to provision for bad and doubtful debt. Then on the liability side is sundry creditor. Sundry creditor will take 6,400 less reserve for discount on creditors. This is 2.5%, means 5 by 200. So 6,400 into 5 by 200. So it is 32 into 5, 160. So 160 will be deducted from sundry creditor, and the profit loss credit side is shown by reserve for discount on creditor 160. then included in the stock at the beginning of the year 10,300. So it is given stock at the beginning of the year 10,300. Included in the stock at the beginning of the year 10,300. So stock as on suppose 1st April 23. It was 10,300. From 10,300, 300 belongs to stock of stationery. So minus 300. This is opening stock 10,000. Then stock of stationery here. Stock of stationery 300. So we have to deduct from goods, stock of goods. So it on stock of stationery. This is opening. Include the general expenses account, the expenses of stationery purchase 500. Stationery purchase include the general expenses account. So we will deduct from stationery purchase. That means from general expenses profit loss account. Profit loss account it is given general expenses. Then we will deduct less stationery purchase wrongly included. Stationery purchased wrongly included. So general expenses will reduce on profit loss account. Wrongly included. Amount is 500. Here we will deduct 500. Then here purchase of stationery. Opening stock was 300. Purchase of stationery was 500. So total comes to 800. Then it is written including the closing stock of 10,400, stationery 400. So closing stock of goods as on 31st March 24. It is given 10,400. Out of 10,400, 400 is closing stock of stationery. So we deduct closing stock of stationery. So stationery use is 400 rupees. That will be shown on the profit loss debit side. And opening stock 10,000 will be shown in the trading account debit side. Closing stock 10,000 shown both in the trading and credit side and balance sheet asset side. Then another most important adjustment is goods on sale or approval basis. Goods on sale or approval basis, the purpose is that if the borrower agrees to accept the goods, then it will be treated as actual sale. So when we are selling the goods, we are debiting to our customer. So customer account debited. Customer means sundry debtors. Customer means sundry debtors debited to sales. Then what we are doing? We are including to output SGST. Then to output IGST. Then CGST. If it is intrastate, otherwise to output IGST. All of you know, although the output AGST, CGST, IGST, the balance amount at the end of the year will be shown under liability side. This will be shown under liability side. That is known as output. But at the time of purchase, whatever input GST we have debited, it will be shown on the balancing amount will be shown in the asset side of the balance sheet. So here, if the goods, when we are selling the goods, we are writing sundry account debited to sales to output AGST, output CGST, output IGST. When the customer agrees that or approves that whatever we have done, it is correct. Now, suppose at the end of the year, the customer did not, or customer is having time regarding whether he will approve or reject. Then in this case, we have to make two journal entries. First, we will reverse the sales. So we have done sundry debtor account debited to sales. Now we will do sales account debited. Sales account debited to sundry debtors or to debtors account. This amount is sales proceeds. Sales proceeds. Whatever sales proceeds we have done, that we have to do. Then it will be shown under stock. So we will debit stock account debited or closing stock account debited to trading account. But this will be shown at cost price of goods. This is in case of goods on sale or approval basis. Goods and on approval basis, recorded sales in the books earlier, now cancelled all sales on the last day of the year because approval regarding sale not yet received. Then stock debited to trading account cost price of goods. Then it is given reserve fund. It is very simple. In case of reserve fund, we will debit profit and loss account and credit reserve fund to reserve fund. Then the reserve fund will be shown on the liability side as reserve and surplus from the capital. Then deferred revenue expenditure. What is deferred revenue expenditure? Sometimes the business incurs heavy amount of expenditure on advertisement which is neither revenue nor capital in nature. So this is known as deferred revenue expenditure. Suppose expenditure was 1,50,000. It gives benefit for 3 years. So every year 50,000 will be written off on debit side to advertisement written off. The amount is 50,000. Then in the balance sheet asset, under fictitious assets, then balance sheet we will write advertisement amount was 1,50,000 less written off 50,000. So asset is, first year asset is 1 lakh. Then second year again we will debit the advertisement written off 50,000. Our balance will be, asset will be reduced to 50,000. Third year the entire amount will be charged to advertisement written of 50,000 and the asset will be nil. This is all about deferred revenue expenditure. Then last but not the least, loss of stock by fire. There are possibility because in business the unit of stock is fully insured. If it is fully insured, then the entire proceeds will be received from the insurance company. So debit insurance company debited. Insurance company debited full amount to goods lost by fire to suppose purchase account to purchase. If it is having GST, then we will write to GST like SGST, CGST or IGST, whatever that may be. Suppose it is partly, this is insurance company with debit. So insurance company is shown under asset. It is asset. Then this will show under trading account debit side. Then GST if any, we will be, that is input GST, that will be adjusted from debit input GST. Then suppose it is part, suppose we are receiving the check, we will write bank account debited to insurance company. So instead of showing insurance company on asset side, we will show bank on asset side after receiving the claim. Second, suppose it is partly insured. Partly insured means whatever insurance company agrees, will debit to insurance company. Not agree, will debit to profit and loss account. Then to purchase, to input CGST, SGST or IGST. Suppose 100% insurance company is not paying, the entire amount will debit to profit and loss account. The entire amount will debit to profit and loss account, that is loss of goods by fire not covered under insurance. Then will credit to purchases account, to input, suppose it is interest rate, input SGST, and to input CGST. If it is interstate, to input IGST. So this is all about the input and adjustment of final accounts. Thank you for watching this video. In the next video, we will solve some problems for clarifying all your doubts on final account adjustments with GST also. If you find any difficulty, you can request me or you can give your grievance in the comment box.